Well, it looks like there's going to be some big changes coming down the pipeline for future buyers, mortgage holders, those looking to refinance, restructure, or buy a home in 2025, according to OSFI, the Office of the Superintendent of Financial Institutions. That brought us great things like the mortgage stress test, the mortgage qualifying rate, as well as now the loan to income changes that we're going to talk about on this week's episode. Is it going to impact a lot of home buyers? Is it going to impact people that have mortgages and looking to refinance? Is it going to change the direction for move up or move down buyers? And more importantly, is it going to really impact the banks? Are the banks going to stop lending? And that is the million-dollar question as we analyze this and look at the real estate market right here in Canada in 2024. Want to take an opportunity to share our thoughts and opinions on the matter. So we welcome you back to the channel. It is Friday, Finance Fridays, and I'm your host, Anthony, with In Touch Mortgage Solutions. And if you haven't subscribed to the channel, we invite you to do so. Go ahead, smash that notification bell so you get notified every time we post a new video. And don't forget to leave your thoughts, questions, and comments in the comments section below, and we will address those questions in a future episode. But now let's get into OSFI's changes that came out last week. Now OSFI is bringing back to the table this conversation around changing loan to income requirements for mortgages. Now, in 2023, this conversation was brought to light, very quickly seemed to die off, but now it is back on the table and it will take effect in some shape, way, or form in 2025 Q1, according to what OSFI has reported. So looking at this, what does it mean? So if you have a specific mortgage amount that you're looking for, it's going to be determined on the amount of income you or your household is earning. So let's use a very simple example. If you were to have a household income of $100,000, you are eligible to qualify on that income times 4.5. That means a $450,000 mortgage. And as you can see, whether you're moving up and down that scale in income, it does either increase or decrease the size of your mortgage and what you're eligible to take on. So that is something that is now being implemented, and we can look at a few different examples. There are so many different scenarios. We do have our mortgage app in the description box below that you can download and play around with that particular calculation based on your income and see how much you're eligible to qualify for based on your current income right now. Now, I really think it's important to understand a few different components. Who is OSFI? OSFI is the banking regulator, the watchdog that looks over the financial institutions, especially those that are federally regulated under their jurisdiction. Not ones that are not, but the ones that are. So they're implementing this rule in conjunction with the stress test. So this is, for some, maybe considered a double whammy, but ultimately I'm looking at the way that OSFI is positioning this in a time period where banks are under the pressure to make sure, hey, are they lending to the right people? Are they lending in a right environment? What could happen if interest rates drop, like we saw interest rates going to an extreme low just a few short years ago? I don't think we're going to get to that point, but how the qualification could change, run up in home prices, amount of leverage and exposure to Canadian borrowers. This is where OSFI, which regulates the banks and not consumers, is trying to step in. Now, ultimately, there is bleed over, right? When you change the way banks lend, you change the demand side, well, that's going to impact clients and consumers who are trying to achieve a mortgage of X amount. And if their income now is not supportive, what does it mean for them? So, there's many different scenarios where I can see this playing out in a good way, in a bad way. For example, someone who's earning good money, who's self-regulating their mortgage and saying, hey, I don't need that much of a mortgage. I know I make this amount of money pre-tax, right? This is all conversating around pre-tax money, not after tax. How much can I qualify for? And then pulling back on that amount. But I find the problem is, what if you're retired? What if you're looking to purchase a home and, for example, one person's off work, maybe not earning as much, and you need to make this move. Do you have to wait now? What does this mean for move up buyers in the market? A lot of things to really unpack here. And as the ink begins to dry, I think we'll get a better picture of how things will shape out in some of these scenarios. But ultimately, it doesn't apply to certain types of mortgages. So what are those mortgages that this loan to income does not apply to? Well, it doesn't apply to insured mortgages. Those are the ones that are less than 20% down payment, taking on that 25-year amortization with a purchase price sub $1 million. So those particular mortgages are already scrutinized, very regulated. There's a lot of scrutiny on those particular mortgages. When we look at gross debt servicing ratios and total debt servicing ratios, just as a quick recap, we've talked about this, but the GDS, the gross debt servicing, is a full combination of your principal, interest, heating, and taxes on the mortgage. And then you have your total debt servicing, which is principal, interest, heating, and property taxes, plus any other debt that you're bringing to the table, like student loans or car loans or credit card debt, any of that encompassing. It has to be no more than 39% GDS, no more than 44% TDS. And with an insured mortgage, you cannot exceed that threshold. So there's already some tight limitations there. The other important thing to really consider now is what we're talking about. So we're talking about what we call conventional mortgages. Those are mortgages that clients are putting 20% or more down. They can take a 30-year amortization and they can buy or purchase for a home over $1 million. And ultimately, these mortgages are not generally backed by any of the insurers, so the lenders can't insure some of these mortgages. So we're talking about ones that are on the bank's balance sheets. So what does all this really mean, Anthony? What are you trying to get at? Well, right now in the current lending and mortgage environment, lenders that are looking at some of these clients, especially the major banks, they will make exceptions or capacity exceptions if the ratios, that gross debt servicing or total debt servicing, are slightly elevated based on certain measurements or criteria. What are those measurements? Well, they're looking at the credit, right? So based on the existing credit, if it's strong, well, that means that, there's a good possibility the lender is going to like the deal. Then what is the down payment? Is it 20% or more? Are you limping in with 20%? Or are you putting 25, 30, or 40, 50% down on the home, or you move up buyer with a huge amount of equity? And ultimately, what do those numbers look like? Then the other component is, do you have a net worth, right? Do you have assets and liquid assets like RSPs, stocks, bond, mutual funds, rental properties that have a good amount of equity in them? All these things are what the bank look at to facilitate an exception for existing clients right now. We're not talking about 2025, we're talking about right now in this environment. And we've seen some of these lenders exceed, that threshold of 39, 44, and some of them will go up to, around 44% GDS, all the way up to 50% TDS, depending on the scenario, and some a little bit over, depending on how strong the deal is. And this is where, a lot of deals may be in this bucket, depending on your situation. We're seeing some of the clients in that bucket, but most of them are self-regulating. They're, staying within those limits. They don't have that problem. They're not really stretching their budget. So how many actual mortgages will this rule impact? That's the other question, right? Depends on your income, depends on where you're buying, depends on what happens with interest rates as we move forward in the next 3, 6, or 12 months. Also depends what happens with these banks, with these provisions for credit losses, mortgage defaults. That is a big topic. Also, we talked about it on both episodes the last 2 weeks. But, we're looking at it from the perspective of the bank, who is still allowed, according to OSFI's, dialogue right now. What they've showcased is that they'll still allow a certain percentage of a bank's portfolio to operate in that space, that mortgages over that 4.5% income. So that begs the question, how big is that segment? How big is the portfolio allocation? How are we determining what bank gets allocated less or more? Is it going to be based on how many defaults they have on their books? Is it going to be based on what their provisions for credit losses are? How many bad loans did they write? Is it going to be based on shareholder performance? Is it going to be based on profits? We don't know yet, right? This is exactly it. Are they all going to be allocated the same amount per quarter? Not per year, but per quarter. So they can write as many loans as they want per quarter that exceed that 4.5 times income. Now, the other question is, who are they going to grant these loans to, right? Are they going to grant that exception to go over 4.5% to the individual that's maybe just limping in with 20%, doesn't have the strongest credit score, doesn't have any net worth? They're just trying to start a family, buy a home. Some of the very hot markets like Vancouver and Toronto, are these the clients? And are they going to discriminate, right? Because they're going to say this person is eligible to buy, but this person is not, right? So this is where things get a little bit more interesting And I really think this requires a lot of attention on the bank's part, because this could negatively pay out for a lot of the banks, because, you know, how does one person get approved and the other? And what is that criteria? And will they actually publish that criteria for their, you know, their actual clients? So this is something that we look at right now. It's based mostly on the covenant. You know, better the down payment, the better the credit score, the better the net worth, the better the chances of getting the exception. And with this rule now, does it give the banks cover to not lend in these particular segments? And how will that all play out? Let us know what you think in the comment sections below. But ultimately, talking about all that, this could have a negative impact on the real estate market or a positive market impact, because depending on how you look at it, yeah, you might have less buyers in the market now because their incomes may not qualify. That may push buyers into a different segment. But ultimately, is it going to push first-time home buyers who are in a similar income bracket into areas or home prices that are going to be at that $1 million or less, or just over that $1 million mark? And is it going to create more competition in those markets? Because, you know, that is obviously going to be the income qualification now, or the down payment qualification. So how will this really play out? And talking to some individuals there, you know, sort of the jury's out. Some of them are mixing, hey, this could really help level home prices, so we won't see these sporadic increases. We're going to see, hey, a little bit, you know, less inventory coming to the market, because maybe someone who owns a home who doesn't show the income may not qualify, and they may not move, right? They may not make that jump. Or are they going to push individuals to make that move ahead of time, right, before 2025? This is really a question for the masses, and say, hey, what do you think is going to happen? Because realistically, we don't know. We don't know how this is going to play out. Buyers are resilient. The market continues to tackle, or I should say OSFI continues to tackle the demand side, and little is being done on the supply side, because ultimately, if we see these restrictions being applied to the demand side, well, what does that do to builders? Are builders going to be inclined to build more properties with less qualified buyers in the pool? That's $1 million question, right? And as we unpack this journey, as we continue to go through this journey together on the channel, you know, we'll sort of unpack that. So we invite you to make sure you subscribe to the channel, so that when we do have these conversations about what is happening with OSFI, what do these rule changes really mean, and most importantly, asking our viewers, what do you think it's going to mean for the future of home buyers, future of mortgage holders, and for the real estate market? Let us know in the comment sections below. But we'll leave the video here. Wishing everyone a wonderful Friday and an even better weekend ahead. Thanks again for stopping by. We'll see you next week.